Well, good afternoon, everybody. My name is Richard Collier. I'll be chairing this session on the current ALP system, basically. We've spent the morning talking about ongoing reform and what are fundamentally new approaches to the international tax system. This session is about the existing rules that we have, the existing income allocation rules, namely, specifically, the arm's length principle, the ALP. Now that's highly relevant, in my opinion, because the ongoing reform is largely a response to the problems of the existing system. And that response comprises a number of different approaches, the backstop that's provided by Pillar 2, the partial substitution of the system by Pillar 1. But one interesting feature is we have spent relatively modest amounts of time, with one exception which we'll be talking about the existing system and the problems in it that we're responding to. In this session, we'll be looking at three themes relating to the operation of the arm's length principle or transfer pricing, each giving a different aspect or element of the current system. Let's turn to the first point, which is over the last 15 years, we have seen a major shift, really quite a significant shift in the way the ALP operates. There is now a very big emphasis on certain human activity, chiefly decision-making, which is used as providing the anchor points for the allocation of income, overriding any legal arrangements if they're different. Some of you may know this approach as value creation, the label that it was given in the BEPS project. The high point of this approach of really relying on the location of human activity and decision-making was reached in the BEPS transfer pricing changes in 2015. But in my experience, they've clearly taken a small number of years to really filter through into the mainstream in the way they're applied. Now, we'll be referring to those rules. They are the rules on risk, or risk framework, or control of risk. And they sound like some very specific, narrow set of rules, but actually they provide the fundamental basis for the whole transfer pricing approach. And our first speaker, Dykes, on my immediate left at PwC, will address those rules and pick up some of the implications and problems they create. Secondly, over time, the application of the ALP and transfer pricing has become ever more complex. That was clearly a theme of the discussion this morning. That complexity is one of the factors behind the UN developments, which I think we heard this morning. It's a factor driving dissatisfaction with the current system. As Manal and Paul both mentioned this morning, the Pillar 1 package includes the Amount B workstream, which is intended to deliver a simplification of the ALP in specific circumstances. Our second speaker, Alison Lobb from Deloitte, will explain and assess this development. Finally, our third theme relates to the work of the European Commission on transfer pricing, the ALP. The recently proposed transfer pricing directive is intended to improve and make more uniform the application of transfer pricing in the EU, as well as addressing some of the more difficult issues that is created or presented by the application of the ALP transfer pricing. Our third speaker, Roberto of Kindred Group, will explain and comment on what is being proposed. Biographies on all three speakers are included in the conference bump that you've probably got in front of you. We're going to take some questions after the three speakers in just the same way we've done before, but let's start off. Ian on risk.
Good afternoon, everyone. Thanks, Richard, for the invitation to this event. I'm going to speak about the risk control framework. one of the issues with the risk control framework, it sounds completely obscure, and it also sounds it's really boring. So it's like kind of coming to this event thinking, no one's going to really want to engage with this topic, and that is part of the challenge that we have here. So what I'm going to be talking about today, you might also have heard of the phrase DEMPI. This is development, enhancements, maintenance, protection, and exploitation of intellectual property. So if any of you are involved in transfer pricing will have heard of this term. I'm really talking about the same thing. The rules work in a similar way. Despite the obscurity and boringness, this is a huge issue, as Richard has said. In fact, most of the large MAP cases that I'm involved in, many of the disputes that PwC, I'm sure it's true of Deloitte as well, are involved in with HMRC, have this issue at their heart. And to add to this kind of difficulty of engaging with the issue, it's very complex. HMRC have just released guidance on this topic. Their guidance is 44 pages long, and it's really difficult to engage with. So I'm going to try and distill this in 15 minutes, which is quite tricky. It's one of those subjects which you can talk about for either a week or 5 minutes. So I'm going to try and do it in 15. As Richard, I'll put my glasses down. As Richard said, this risk control framework was essentially the centerpiece of the BEPS work on transfer pricing. What was it aimed to address? Well, one of the perceptions, in fact, probably the reality was of the BEPS kind of the picture that was driving the BEPS initiative was that some multinationals had invested in their intellectual property, or they had subsidiaries in low-tax jurisdictions that had made the investment in intellectual property, and as a consequence of that, the profit associated with that intellectual property would flow to that location. The general feeling that was the main, or one of the main, kind of transfer pricing related pieces of planning that was driving base erosion. So, what the risk control framework does is introduce a test. This is in itself quite interesting because the test is embedded in the transfer pricing guidelines. The guidelines, as we know, are OECD guidance on how to apply the treaty, but now we've got a test in there. And the way this test works is to say, okay, so you've got this subsidiary that's invested in this intellectual property. Now what we're going to be asking you to do is to show that you've got qualified people who are controlling that investment, essentially. And the way you demonstrate that control is going on is that you have decision-making. You show us that you've got decision-making going on in that jurisdiction. That's where risk control comes from. You've got the people who are deciding to make this investment who are also in the territory. So we've introduced this substance over form test into the guidelines. And the kind of substance that we're talking about is decision-making substance. Okay, that doesn't seem particularly unreasonable, but the reality is that within the guidance there are a lot of gaps. There are also ambiguities, and it's also very complicated. Marlene earlier, and part of the discussion earlier on, was talking about the value or the importance of simple ideas. Now, the idea I just put forward, that you need to match the decisions with the investment, that's quite a simple idea, but the way you go about sort of working out whether or not you've done that is very, very complicated. And however, there was one kind of overarching concept that became the mantra for BEPS, which is in itself quite a simple idea. And that idea is that we're aiming to align profits with the location of value creation. It's a pretty simple idea. But what this kind of complicated risk control rule led us to is a position where we said, well, we know the thing that mattered in that investment picture was where the senior decision makers are, and we know that BEPS is trying to align profit with value creation. So it must be the case that our new anchoring convention is the location of the senior decision-making. And this has kind of become an overwhelming kind of belief that's kind of spread since that OECD work was developed. This general idea, if I ask audiences now, and I often do, what is it that value creation means? And I give them options. Most people will say it means kind of aligning profit with the location of your senior decision makers. Okay. Again, so fine. That doesn't seem unreasonable. But then we hit challenges, because what if those people move? And that's really what I want to talk about today, because the OECD's next project, and it's definitely the case that the Secretariat and Working Party 6 are really ready for something other than the pillars. I mean, they've been buried in the pillars for 3 years now, essentially. So they're ready for the next thing. The next thing is the Global Mobility Project. From a transfer pricing point of view, we've got this big issue of, okay, so we've now identified sort of senior decision-making as being a potential source of residual profit, or have we? But if those people move, we're going to have to say what's the consequence for our transfer pricing system. And if you're within a multinational and your board are coming to you and saying, we've hired a new FD, they can't be in the same place that our residual profit is, they're going to be elsewhere, is that okay? You've got a difficult question to answer in that circumstance. So I just want to illustrate now, very quickly, why this creates a challenge. I kind of already done that a little bit, and then I'll kind of go on to talk about some conclusions that might come from that. So the main question I'm asking now is, well, what is the relationship between senior decision makers and residual profit? And that's kind of really the kind of question at the heart of this bit of the presentation. And this is a simple slide. This red block is residual profit. Well, what's that? Residual profit is what organisations derive from their barriers to entry. So in most transfer pricing systems, an organisation will have defined what barrier to entry it is that their profit attaches to. For most businesses, the main barriers to entry are going to be IP of some kind. Patents, brands, technology, but for most multinationals, that's where their residual profit flows to. Okay? So within transfer pricing, we've just got one body of profit to deal with, and the main point I'm making here is that it attaches in most transfer pricing systems to IP or some form of intangible. So now let's map onto this grid 20. Let's imagine we've got 20 senior decision makers in our organisation. And obviously this is a massively simplified assumption, but between them, these decision makers are responsible for all of the DEMP decisions. These are the ones I was talking about earlier. All the important decisions about investment in IP, and they're all in the same territory as the IP. So that's fine. Everything's in alignment. But what if one person moves? If one of those decision makers moves, does that mean that 5% of the residual profit should move with them? What if 8 decision makers out of the 20 move? Should 40% of the residual move in that case? And what if they're all in different territories? In that case, does 5% go to each territory? You can see why it's a difficult kind of challenge, because if we're starting with this idea that it's senior decision making that attracts profit, I've now just split 40% of the profit that I've ascribed to my intellectual property into different territories where I don't own that intellectual property. And that's really the main issue behind, the main problem behind the risk control framework, is that if you are going to split your residual profit based on where your senior people are based, in most cases that, I say here, it doesn't work. It's certainly going to give you massive problems because it gives rise to unexplainable profit shifts. Okay? Why would one individual attract 5% of the profit pertaining to your IP? It doesn't make sense. The economic bargaining power of that one person is generally reflected in their personal compensation. What is it that's attracting that extra profit? And then also, if we've delinked the location of the residual profit from the location of the asset itself, well, what happens then to the capital value of that asset. You've got an income and capital mismatch. It doesn't make sense. Does that mean that if I've moved that 40%, do I now have to do I have to write down this asset in some way? And what is the asset in the other territory? That's a very difficult problem. And then, it's not finally, there's lots of other issues, but what about withholding tax? So if the jurisdiction that owns the asset is receiving royalties and withholding tax has been applied, well, the profit is now somewhere else. How do we kind of match that up? We've got a very difficult wiring problem then. And this is perhaps the most important point of all. It's not how the risk control framework actually works. The risk control framework is a threshold test. So I said earlier on that what the OECD were aiming to do was to come up with some rules that kind of prevented that kind of tax planning in which you could invest in assets in a low tax jurisdiction. What the rules actually say is, and this is the next bit, what the rules actually say is that you only need to have some control in the location of the residual generating asset. You don't even need to have most control there. So in theory, you could still move 40% of your people, and it wouldn't affect where your asset is based, and that in turn shouldn't affect where your residual profit flows to. However, the rules are incredibly ambiguous, and the subsequent transfer pricing guidance on things like profit splits and on financial transactions have added to this ambiguity. And so for most taxpayers, certainly most of my clients, would feel uncomfortable in a situation where an increasingly material proportion of their senior people are not in the same place as their intangibles or as their residual profit. Okay? I just want to illustrate this with a bit of an example. Let's see how I'm doing for time. Am I okay for time, Richard? Okay, good. Let's imagine an example where we have one jurisdiction that has acquired an asset, maybe even developed the asset itself. And let's say that asset is acquired by another company. All of the people in the first territory are removed, and we've got a new territory that's now undertaking the development decisions and the development activity. So here we get two different tax authority views. The first territory will say, well, the decision-making that mattered was the decision-making that happened years ago when we made this asset in the first place. They're the decisions that matter. And we should respect that, and we should respect asset ownership. And the value of the asset doesn't leach away just because we've got some development activity happening elsewhere. And the territory with the decision makers, well, what assets does that territory have? If it has no assets, it has no bargaining power. And so we should be able to use a cost plus for that territory. A TNMM should be okay. And they all say residual flows to the owner of the asset, and that's what would happen at arm's length. And they'd also say, if we're going to concede that the DEMPI should attract profit, then we want an exit charge. Whereas Territory B would say, well, it's the DEMPI functions that are relevant to how we split profit, and it's the current decision makers that matter more than the old decisions. And if all the decision making is over here, then the legal owner should only get a risk-free return. And we can never use TNMM. We can never use profit split if we're DEMPI, because we're too important. So they would say, we think a kind of people-based profit split is going to be the right answer. And they all say residuals should flow to decision-making functions, and that's what aligning profit with value creation means. And they won't care about an exit charge, but they might have to worry about amortization. So I'm rattling through this, but I wanted to illustrate this is exactly the kind of issue that we are seeing in many, many real-life disputes and in MAP situations and in potential arbitration situations. So I will sum up now. So in summary, we have a situation where, as Richard touched on, the critical legal ownership rights and contractual rights, which kind of underpin all commercial relations, for transfer pricing, they have been kind of relegated to kind of second place, and people functions have been given a much more significance. And so it's led to this kind of general belief among some tax authorities that you can do transfer pricing without contracts, that you can just look at the behaviour, and when we look at the behaviour, the kind of approach we should take is a kind of people-based profit split. So we're seeing this being asserted a lot by HMRC in particular, but also by other tax authorities. So HMRC have issued their risk control guidance, and why have HMRC done that? They've done that because they know this is a difficult topic. They want to make sure that their perspective is understood, even though it's very hard to understand, but particularly because they know this is going to be debated again at the OECD, and HMRC want their perspective to be, out there in the open. It's an opening shot in this debate. So anyway, if any of you have got contract R&D type structures, if you've got limited risk structures, or if you've got senior people in the UK, that these are the kind of things that are going to be under challenge, and HMRC's guidance kind of make it clear that in many cases they're going to be looking for a profit split in those kind of situations, and if not a profit split, certainly not a cost plus. Okay, possible solutions. It's easy to kind of despair about some of this stuff. One of the things that it might be possible to think about is that actually, is it really true that all of our residual profit should stick to intangibles like patents and technology? Might it be true that there are know-how-based capabilities within our organisation and people-based capabilities that might attract residual? In that case, might that functionality attract a certain amount of residual? That's one way of looking at this that takes you away from a situation where you're squabbling over the residual that relates to patents and technology. That's one possible solution. And it's also possible that that the OECD might consider thinking about ways of pricing high-value services. They did a low-value services project. It might be a sensible thing to start to think about, are there ways we can think about approaching high-value services that don't involve profit splits? So the challenge, this is Working Party 6's next project. It's a really difficult one. I think the Secretariat doesn't really want to have to go back to BEPS and reopen the risk control framework. The challenge they face is that, as I've illustrated, I hope, it's quite hard to address some of these issues without doing exactly that. And I know that HMRC want to do that, and there are other tax authorities, in particular one big one that was not named earlier on, that has a particularly strong view on this topic and also wants to go back to the mat and discuss it. I'm not sure that's a very good idea. I'm not sure they're going to find that there's much in the way of consensus there. The OECD certainly are, however, thinking about ways that they can do things that are helpful for businesses, like, for example, offering suggestions around situations where a cost plus would be appropriate, saying that cost plus will be appropriate in most cases, and also saying when profit split won't be appropriate and ruling profit splits out in most cases. I know I am going well over time, so I am wrapping up now. Thanks, Richard. Thank you. I said I would be quick. I wasn't, but I hope you found that interesting. I'm going to hand over to Alison now to talk about Amount B.
Thank you very much. Thank you. Good afternoon, everybody. So we've touched on Amount B in passing a few times already today. So I'm going to talk a little bit more detail. This is not my 3-hour presentation, I promise, on Amount B and how it operates, what it really does. So Amount B is a simplification, and it is part of Pillar 1. Now that's a little bit of a contradiction even in itself. It applies to potentially all businesses that have the right sort of marketing and distribution activities. And that's important because, as we know, the rest of Pillar 1 and Amount A only applies to the very largest and most profitable multinationals. Amount B, that doesn't have that threshold. So potentially many, many more businesses in scope. It also doesn't apply to the Pillar 2, €750 million threshold either. So no threshold at all. Importantly, it does remain within the arm's length principle. That's the whole point of our panel. We're talking about the arm's length principle. It's not something outside of that. And that means, importantly, that it's part of Article 9 of tax treaties, and that tax treaties aren't going to have to be amended in order to introduce Amount B. As we discussed this morning, the US in particular requires 67 senators on a good day to get your treaties changed. That's not going to be necessary in relation to Amount B. And that instantly makes it something that looks, to my mind at least, a little bit more doable. The scope of Amount B is around the marketing and distribution of tangible goods. So not services, not digital services, just tangible goods. Some people might claim that that's a little bit narrow or argue that's a bit narrow. I think we all agree with that. But actually it's helpful in this case that the OECD has decided to start with something, work their way through, iron out any of the issues, and then perhaps in the future we might see that scope expanded. It applies to situations where those goods are distributed via a buy-sell arrangement, so the distributor takes title to the goods, or where the distributor acts as an agent or an undisclosed agent or commissionaire. But the distributor has to be the person in country making sales of those goods. And it's wholesale distribution, so it excludes, by and large, retail distribution, so any sales to consumers. Then we get onto the sort of transfer pricing pieces. So the first piece is that you have to be able to look at that distributor or the distribution function and say that you would have priced it in our economic terms as a one-sided method, which basically means that it has to be the simpler party to the transaction. Often you would find that distribution is the simpler party to a transaction, so in ordinary transfer pricing that we've been doing all along, then that would be the case. It also means that the distributor shouldn't have significant intangibles, for example, or be undertaking other functions that are, perhaps have a different reward profile, such as manufacturing. Originally, the rules said that you couldn't have anything other than this baseline distribution function in the entity. The latest paper, the one that came out in February, decided that actually that was a little bit too narrow, so now you can have other functions in there, but you have to segregate out the distribution function in order to apply the rules. You then look at some scope tests, and they're all very quantitative rather than qualitative. So everything that Ian was talking about was very qualitative. You have to understand who is doing what. Amount B is very much focused on numbers, quantitative numbers that come out of the entity's accounts and that can be perhaps more objectively looked at. And then after you've done all that, you get onto the pricing. And this is really the simple bit. And I should say, actually, I actually really like Amount B. I think the OECD has done a good job in relation to this because they have kept it as simple as I think they possibly could have done. Effectively, instead of having every company having to go off and benchmark, with advisors like us or do the work on their own, their arm's length range in relation to their distribution activities, instead, they will use their metrics from their accounts and work out what position and what margin their distribution function should get. Effectively, this is the matrix. This is the basic matrix. This is the one that would be used for most groups. As you can see across the top, we've got 3 different industry groupings. So just 3, all industries put into those 3 categories. Broadly, category 1 is the one where there's typically very high volume goods that are sold by the distributor without necessarily your salesperson having to have too much knowledge of that good. Category 3, on the other hand, at the opposite end, tends to be things that are sold, maybe much larger things that are sold, much more infrequently, and where you would expect that the selling person has to have a lot of knowledge to be able to do that sale. And category 2 is the one in the middle, which is everything else. You've then got down the side different ratios, looking at different levels really of intensity of function in your distributor. Some of them are based on operating assets, so how many assets do you need to make your distribution sales? Others are based on expenses, how much cost do you need to incur in order to make those sales? That's fine, that's just sort of spreading out how much work needs to be done. You work out where you are, you read off your metrics, you know which industry group you're in, and that tells you what your sales margins should be. So as you can see, it goes from at the very lowest 1.5% to at the very highest 5.5%. I've been doing transfer pricing quite a long time, Ian has as well. I think we'd probably say that that range, 1.5 to 5.5 sales margin, looks broadly right for distributors in most parts of the world. So that's a pretty good job. And that's really it. I mean, it doesn't look very difficult, does it? What does that mean? Well, it means businesses need to try and have they need to have an outcome that aligns with these if they don't want to then have any adjustments. you can see there's a 0.5% tolerance. So if your outcome is within 0.5% of that margin, then you're good. And businesses will want to set their prices in advance, I think, to try and get close to that. But it is, I think, a lot easier than this situation where you're waiting for your benchmark, you're updating your benchmark, you're sending your benchmark off to HMRC or other tax authorities, and you're waiting for those questions to come back to say, why did you pick this comparable? Why did you pick that comparable? Why is your range moved from last year? Why is your range not the same as other entities that we're seeing? So I think on the whole, they've done a really good job. There are, of course, a couple of twiddly bits, because it wouldn't be possible to do it without those. And those twiddly bits, I think, are, one, practical, but also slightly political. The first twiddly bit is this idea of a cap and collar cross-check, which looks at the level of expenses that your distributor is incurring and says if that is too high or too low relative to the sales margin that the matrix generates, then we will put either a cap or a collar on that. The way I think about that is it's really designed to sort situations where you've got products which are globally developed, probably with some IP outside of the local distribution country, which are really valuable, which everybody wants, and which kind of sell themselves. Your distributor's not really adding that much to the sales, and yet there's a lot of sales in the local country. So your distributor expenses will be low. You know, they don't have to do anything. Maybe they play golf every Friday and they're still making sales. The point is that there's not very much in expense, but the sales are high. In that situation, you might find that the cap will kick in and say, fine, that we don't want to over-reward the distribution entity in that country. That's fine. It kind of works. And there's, by the way, there's two levels of caps. There's one for developed countries and one for developing countries, which also makes some sense. You might say that developing countries might have lower costs because of just having a lower cost base. Therefore, it makes sense that they can retain a bit more margin. So that's fine too. The second twiddly bit is effectively what they call a data availability adjustment, but it's based on sovereign risk ratings of the country of the distributor. And that means that you make an adjustment where there is effectively a large degree of sovereign risk in that country. That one I think is slightly more political. It's not quite so easy to see the full logic, but fine, it works and it's there. So that's the mechanics of it all, and they've all been agreed. So what's happening now? Well, effectively, we're pretty much in the same place we are with Amount A, and which has been discussed this morning. We're waiting for the implementation of Amount B. Now, the original suggestion was that this could be optional for countries, and that countries could choose whether to apply it. I think that probably would work quite well. We can discuss which countries might apply and which won't. We know that there are many that would like to have Amount B. We've already talked about the African Tax Authorities Forum. Some of the other developing countries like it. The US likes it, which is always a positive if you're looking to get agreement. I think, although they've not said so, I think many of the larger economies in Europe will also be keen to do this simplification. There are one or two countries that are not so keen. India made a number of reservations in the document in February and certainly have some concerns. And Australia has also said that they're not going to apply the Amount B methodology. But having said that, that's not a huge number of countries that are saying, at this stage anyway, that they're going to object. The perhaps more difficult question is, because it's part of Pillar 1, is how Amount B is linked to Amount A, and whether, the difficulties that we can all see around Amount A inevitably end up slowing up the implementation of Amount B. And I think that's the harder bit to call, and we come all back to all the pieces we were talking about earlier on. So just a few sort of other comments. Amount B has not been without its political challenges. In some ways, you should say this should be easy to do. It's a nice simplification project. Everybody understands distribution. It's not as complicated as intangibles and DEMPI. And yet it has had its political challenges. Not all countries have agreed that this is the right way forward. Not all countries have agreed that the matrix, gives an outcome that they're prepared to live with. And that, I think, has been difficult for the OECD, and yet they've managed it, I think, pretty well. This is in some ways the second go they've had at something like this, low value adding services that Ian mentioned being the first one. That one I don't think was quite as successful, partly because it wasn't given a sort of firm enough structure around it in relation to implementation, and also perhaps because it was hard to see, because it was just one number, cost plus 5 in that instance, it was hard to see exactly how that related to the arm's length principle in a number of situations. So I think that one was, but they learned, perhaps the OECD, from trying that. And the question is then, I suppose, if Amount B gets implemented and is successful and is a simplification and does reduce disputes and does reduce, businesses and tax authorities' time, then is that something that the OECD will look at for other areas? The OECD is going to look at services generally in relation to transfer pricing in the post-pillar excitement of being able to look at other things. And I think there is perhaps an opportunity for them to look further at services within that. But I do wonder whether the political difficulties of Amount B means that perhaps in the end countries might prefer to look at that and come up with best practices rather than necessarily come up with something that has to be applied by all. And the problem with most simplification mechanisms is they really work best when they're applied by a lot of people and therefore everybody gets the benefit of it. They're much less useful if they're done piecemeal. In terms of timing, this is supposed to start from 1st of January 2025, as it's supposed to go in the transfer pricing guidelines from 1st of January 2025. I do think it's possible the Amount A piece will slow that down, but it could be as soon as that. I think with that, I'm running out of time, so I shall hand over to Roberto.
Good afternoon, everyone. Thank you for inviting me, Richard. As mentioned earlier, today I'm going to talk about the proposal for a Council directive on transfer pricing. Now, let's start with a brief introduction. The European Union is introducing a draft directive in relation to transfer pricing, and this is part of the broader BFIT package, which is a set of rules which aims at harmonizing corporation tax in Europe. Now, today I'm going to focus on the transfer pricing directive, and the purpose of that directive is, in fact, to harmonizing transfer pricing rules within the member states. In terms of timeline, the proposal of the directive is to have the member states to comply with the directive by the 31st of December 2025, meaning that effective date would be 1st of January 2026. Now, before going into the detail of the directive, let's have first a look at the current state of transfer pricing in the EU. And you might be wondering, why is the European Union introducing a transfer pricing directive if there is already a widespread adoption of the arm's length principle across the member states? Now, that's true. However, the arm's length principle, as per Article 9 of the Model Tax Treaty, is not defining transfer pricing rules in detail, and therefore the way the different member states are applying the rules can be very different across the different jurisdictions. And that is obviously resulting in a lack of uniformity. And when it comes to the lack of uniformity, with the directive, the EU wants to address a further reduction of any loopholes that may allow opportunities across member states for profit shifting. The aim is to reduce uncertainty that may arise from the different application of the rules, and that for taxpayers in the EU may result in the EU and not in the EU will obviously result in an increased burden coming from tax disputes, but also in a high cost of compliance if you think about the fragmented requirements when it comes to the compliance for transfer pricing purposes in the EU. Now, what are the solutions that are being proposed by the directive? Now, the objective of the directive is to deliver more certainty. And the first step in the directive is to include the arm's length principle and the OECD transfer pricing guidelines within EU law. And this will serve to deliver to member states a common framework, so the OECD guidelines as the mean to interpret how the arm's length principle should be applied. There is also scope in the directive for establishing common definitions. For example, when it comes to the definition of associated enterprises, we often see different thresholds when it comes to their definition. Some jurisdictions use a lower threshold, closer to the one that is in the directive now of 25%. Others do use a higher threshold of 50%. So in the context of an audit which is involving a transaction between two different jurisdictions, those different definitions can create a significant element of uncertainty and confusion. The directive is going to incorporate the core elements of the OECD transfer pricing guidelines. So we're talking about, all the guidelines around the accurate delineation of the transactions, the ME methodologies, the selection of the most appropriate method, and so on. The aim of the directive, as I've mentioned, is around ensuring the consistent application of national rules with the OECD transfer pricing guidelines. So this is an interesting point here because what the EU directive is doing is introducing the OECD guidelines into law, but then it's also mandating the member states to transpose that directive into national legislation by ensuring that they do so consistently with the OECD guidelines. Another interesting point is that the directive is seeking to empower the European Council to establish specific binding rules on specific transactions. Now, there is a listing of those within the directive, which, for example, include the transfer of intangible assets or transactions in relation to the rights related to intangibles, cost contribution agreements, and so on. There is also another point which is worth mentioning about what this directive is trying to introduce, which is a so-called fast track in order to resolve disputes across member states, and that aims to introduce an accelerated framework where those disputes should be solved even outside a MAP context within a much lower period of time of 180 days. Now, moving on, of course, there are certain challenges and considerations which is worth mentioning when it comes to the EU stepping in with a directive on transfer pricing and also willing to establish new guidelines in relation to specific transactions. Now, I would like to start with interpretational issues that could be expected because, as I mentioned at the beginning, the EU has a goal to deliver more certainty with the directive, but the fact that there is going to be an incorporation into EU law of the OECD guidelines, it doesn't necessarily mean that the interpretational issues that already exist within the OECD guidelines will be solved. So most probably, those interpretational issues will remain in place. And, if we think about various complex transactions, but just to refer back as well to the risk framework that Ian was talking about, that will still present some challenges, and so the directive will probably not be the solution to all the issues there. Another interesting point about the directive is that it's trying to introduce simplification. And among the simplifications which are being introduced, there is one that is particularly interesting, which is about the treatment of the PEs. And when it comes to permanent establishments, the EU directive is trying to, what is actually proposing to bring the treatment of transactions of permanent establishments within Article 9 of the Model Tax Treaty. So it's something that is certainly a simplification, most probably coming from the difficulties that tax authorities and taxpayers have encountered in attributing profit to permanent establishments using, for example, the existing guidance around the OECD approach on the profit attribution to permanent establishments. But the EU directive is not giving a solution around how would it work in that case, with the determination of the assets and risks that, for example, need to be attributed to a permanent establishment, which are not in the scope of Article 9, but usually covered by Article 7, and in fact by the extensive guidance that is already available with the AOA. Now, there are two solutions there. Either the EU at some point endorses the existing guidance, but that in the context of having all member states to agree to that will probably become really challenging, and will become really challenging first because there are complexities around the attribution of profits to permanent establishments, and there has been criticism by certain EU member states around the use of the AOA approach when it comes to the attribution of profits to permanent establishments. Another solution could be the EU coming up with its own guidance, but at that point, imagine a situation where we start having the EU producing its own guidelines in parallel with the OECD, and at that point, you may end up having literally a duplication of guidelines and add additional complexity to something that was aiming to simplify, actually, the profit attribution to permanent establishments. Another point which is, again, worth mentioning is the challenges that could be around the uniform application of the directive as it stands. Now, this is a directive at the moment, a proposal for a directive at the moment, but when it comes to transposing the directive into national legislation, what does it mean? It means that most probably all the member states that already have their own domestic transfer pricing legislation will have to invest significant resources in amending their own legislation, and that could become, again, sensitive from a political point of view, because at that point you may have certain jurisdictions that today have a higher burden, for example, of compliance, giving up on some of those requirements if they have to abide to a uniformed approach. And that goes directly into the point of the documentation. The directive is also proposing steps towards simplified compliance, but again, the initial adoption can be really difficult. And what does it mean, an approach towards simplified compliance in the end? Does it mean that the EU is going to introduce its own set of transfer pricing documentation, or will the EU propose to stick to the OECD standard 3-tier with master file, local file, and CBCR? Well, this is again a difficult answer, and again, there has to be, there will certainly be some political challenges around the domestic requirements about filings that go beyond the OECD standards. Today, we have jurisdictions like France, Belgium, and so on, that on top of the TP documentation require additional transfer pricing filings that may go together with the tax returns or not. So is the EU going to simplify those additional requirements? Are they going to remain in place? Last but not least, another simplification, if we want, that has been introduced, that is being proposed by the directive is the use of the interquartile range instead of the full range when it comes to testing transactions in the context of benchmarking studies. So when we test the price of a transaction from a transfer pricing point of view, we do use a benchmark, we do use comparables, there is a range of results that the pricing can fall in, and now the EU directive is proposing to use the interquartile range. Now, this can be certainly a way to simplify things if you think about transactions that are happening within the boundaries of the EU. However, that starts becoming complicated when you start having transactions between EU and non-EU member states, but also where the availability of comparable data is relatively limited. There is, I personally had the experience of, as a former advisor of tax audits where the tax authorities were cherry-picking a particular entity, for example, inside a benchmarking study and considered that the perfect comparable. So again, there are complexities around the simplification proposals that are being introduced by the directive that definitely need to be addressed in more detail. So I would like to conclude by saying that, by going back to the opening, is the proposal from the EU directive really coming up with more certainty, or is it actually going to add higher complexity to taxpayers and even the way tax administrations administer transfer pricing related matters? Now, the answer depends. It really depends on how the next steps are going to be approached in relation to this directive. Considering past experience with application of directives across member states, and Pillar 2 is one of those, one of the most recent ones, they proved very often not that straightforward, and therefore I would say that whilst there is an element of harmonization, which is definitely going to be delivered, the element of complexity to taxpayers and tax administrations probably will not be massively reduced. Thank you very much.
Well, thank you, Roberto, and all the speakers. Let's move on to questions. You may have questions on the three themes that we've tried to explore this afternoon, namely the attempt to stop avoidance by a more substance-based approach in terms of the comments made by Ian, or the comments made by Alison about trying to reduce complexity in a way that's not been successful previously. Or again, as Roberto's outlined, the European Commission attempt to make matters more uniform. Or you might have some other questions to do with, for example, the metaverse, mobility, or AI, or whatever. I'm going to open the questions, if I may, by asking a question on which a brief response is requested from my panelists. And I'd just like to ask you, start with Ian, if we stand back from your presentation, and the same question to all three of you, if you stand back from your presentation, what is it that the themes and issues you've been talking about tells us about the ALP and where we are with the ALP and transfer pricing? Ian.
Okay, well, Grant brought us Jane Austen earlier on, so I'll bring you some Coleridge. And transfer pricing involves a willing suspension of disbelief. This is the real problem that we have here. We're pretending that a multinational is made up of pieces that behave like third parties, and they don't. You know? And the more explicit we try to be about how we go about the exercise of pretending, then and the harder we push for clarity, the more the strangeness of the exercise is revealed. And so it's mind-bogglingly hard to engage with some of this stuff. And it's no accident then that we end up with tax authorities saying, well, if we're not going to use contracts, then what are we going to use? And we end up with people-based headcounts. It's a form of formulary apportionment. Amount A is a form of formulary apportionment. We're kind of creeping towards it. I'm not saying I think it's a good idea, but I do think that the arm's length principle is creaking. I don't know what the answer to it is, to be honest with you.
Alison, about complexity.
Yeah, it's interesting actually, because I think that amount B is a really good example of showing that the arm's length principle can work in some situations, but you can make it simpler and easier for everybody by having, your benchmarking done centrally, by having a matrix, by reducing the parameters for error on something that, after all, in my experience, never gives you one single answer that you know for sure is right. You're always going to have a range of possible outcomes. This does that range for you, and I think actually it supports the arm's length principle as being perhaps, not quite dead yet.
Okay, and would you say that the barriers to complexity are more political than technical based on what you took us through?
I think so, yes, because actually, when you look at it, it has been possible to simplify in relation to distribution, which obviously is only one area of transfer pricing, but it has been possible to do that. On the other hand, some countries have, held out or argued their case because they think they might get more income, effectively, from the existing rules. So there is that element of politics that's going to come into it, and I think that's going to be inevitable in any negotiation. That's going to be inevitable.
Roberto, what should we take away from the TP directive attempt to make transfer pricing more uniform or commoditised?
Yeah, as I was mentioning earlier, there are a number of simplifications that the directive is trying to introduce, and now those simplifications are probably trying to shape the arm's length principle in a way that is probably artificial or that is not really arm's length in some situations, right? So if you're trying to introduce a simplification, trying to introduce a more formal-like approach to do that going forward, then that's probably against the arm's length principle in itself, where there is not just one right answer. So the point is, well, if we want to come up with more simplification in the future, we should probably still be brave and think out of the box and consider if alternatives to the ALP are still out there and whether they could deliver a more equitable answer going forward when it comes to transfer pricing issues.
Okay, let's turn this over to the audience. Richard, you've got a question. If a microphone could arrive, that would be great. And if you could just say who you are and then ask a question.
Yeah, Richard Tether, Forvis Mazars, but this is more personal question, really. As you say, there's been a lot of changes and lots of things are being chipped away from transfer pricing and the arm's length, global minimum tax, Pillar A, formula reapportionment, even Pillar B is removing all that scope for, well, frankly, for the interesting work that we used to do back in the 90s or whatever. But, think how much life do you think there is in that? Thinking back to when I was university lecturing and students would ask me about career choices and think, if you had a 20-year-old coming to you asking you about going into transfer pricing, do you think there's actually going to be, is it going to stay interesting enough to last a career?
Well, I've certainly got a very strong response to that, but let's hear from the panel, and you've got 2 sentences.
Well, somebody coming out of HMRC asked me the same question recently, because they couldn't believe the arm's length principle had a future. And I really think it does, because I don't know what the alternative is. That's the main issue. Notwithstanding everything I said about it creaking, I just don't know how we get consensus about an alternative. So I would encourage my children to go into transfer pricing, and I do.
I would agree. We've had situations in, say, within the EU. We've had, the CCCTB, common consolidated corporate tax-based proposal for a long time. We've now got the BFIT, its successor. Amount A has been really difficult. It's only applying to these, top 100 companies. It's not going to be put to everybody, even though it does have that element of apportionment. Actually,
What can countries get behind? They can get behind the arm's length principle as being something that they can look at and understand and try and apply in a way that gives them a chance of getting the return that they think they're due. And I don't think anything else has yet been shown to be able to do that.
Yeah, very briefly, it's there to stay for sure, but all the initiatives that we're going to see will probably shape it in a way that I don't know what's going to stay of the arm's length principle if it's just a name, and then we're going to see more and more different ways of applying it through formulaic approaches or more creative alternatives. Yeah.
Yeah, so 2 quick comments from me. I really meant what I said about the work on the pillars. It is absolutely remarkable how little we talk about the ALP, even though it is the problems of the ALP that have driven the reform. So that's the first, and that's reflective of the fact that people just do not want to go there in terms of looking at getting rid of the ALP, or at least not more than the very limited amount of movement in Mount A. As for the question about your son, I would say if you look at income allocation more generally and look at the inevitability of diverse approaches to income allocation that we're going to see, given the weakening of the arm's length principle. So if we look at it as amorphous, massive income allocation approaches, I would say that your grandchildren's grandchildren are safe in a job for life. Next question, please. Right at the back in the middle, please.
Hi, I'm Alvaro. I'm an MSc student here. I wanted to ask Ian about the risk framework. I think it's clear that it's a difficult topic, and HMRC guidance is not easy to grasp, as Chapter 6 is not either. And the risk framework in Chapter 1, especially when you think about intangibles. But one thing I have always thought, and I wanted to get your take on, is normally if you work in a non-confrontational way with a group and a tax administration, you can arrive to a sensible economic outcome or model to arrive at something that with more or less would be compatible if you take a holistic view of what should be the right price. The problem with that is that it's very unlikely to be the same outcome that you will get with the other tax administration when you seek relief in MAP. And that, especially it kind of deters the ambition of groups of engaging with tax administration in that perspective, because they know that unless you have like really supported objective data backing up whatever you agree, which is very unlikely because it's very subjective, you won't find that relief with most tax treaty partners. So my question is, why do you think mandatory arbitration, which is something that would encourage tax administration to present their most reasonable case to a third party to decide on, has not been pushed harder in the agenda? It seems to me that it's easier through mandatory arbitration to find that certainty that is that to fixing the risk framework regime, or to address the ALP problems that, I mean, there are many of them.
I think the short answer is I totally agree. And I think we're in a situation where the more we try to be explicit about the way the rules work, the more you're getting entrenched positions that are quite far away from each other from some tax authorities. I'd like to see more investment in the competent authority functions, and I actually see more engagement from clients in advanced pricing agreements than I used to, and there's more MAP engagement going on. So it's not that isn't working, but I think mandatory binding arbitration, baseball arbitration, is really, really important. And I kind of think all the things we've spoken about in terms of the ever-increasing complexity, you've only finished your transfer pricing when both sides have agreed. And I think mandatory binding arbitration is important, but also if you like, the peer policing structures within Action 14 and just generally speaking within the MAP forum at OECD are very important, because we still have a lot of tax authorities who basically say, if you agree to this, then I'll make you this offer as long as you don't go into MAP, and as long as you don't take us through arbitration, which is very bad behaviour, but it goes on a lot. So not only do you need to have the processes, you need to have the behaviours that go with it. And at the end of the day, the reason we're not seeing as much mandatory binding arbitration as we'd like is that tax authorities don't want to be held to that standard, essentially. So it's at the end of the day, it's a question of trust between tax authorities. But I completely agree, mandatory binding arbitration, as much of that, more of that, and that would be a good thing.
Okay, so
sorry, Richard.
Just taking a couple more questions. Let's take two questions now. First from Philip, the second from... Philip.
I actually have two questions, I'm afraid. Sorry, John. I'll try and put it quickly. One of them is to Roberto. Is the introduction of a transfer pricing directive, does it have, I think, possibly three unintended consequences, or maybe they're not unintended? One of them is that every transfer pricing case in Europe is capable of going to the European Court, and many will. Secondly, because countries are now going to be implementing European Union law, the Charter of Fundamental Rights will apply. So that means, for example, a right to a fair trial. So arguably, MAP is out the window in all transfer pricing cases, because that wouldn't meet the requirements. And thirdly, and this may not have been unintended, effectively state aid, the Fiat case, is reversed. And I think that was intended there, so that the Commission can now go back and reopen or start a whole new load of state aid investigations based upon transfer pricing rulings, plus the foreign subsidies regulation allows them to extend that outside the EU and ask whether transfer pricing rulings being given outside the EU constitute foreign subsidies. So there are three big consequences potentially. If I may, my other question is actually to Alison and to Ian very quickly. Why do amounts A and amount B have to be linked? Seems to me that there's absolutely no reason why they need to be linked at all. We used to believe that Pillar 1 and Pillar 2 had to be linked, otherwise the edifice would collapse. Now that we know that the edifice has collapsed in any event, do you see a time when, frankly, amount B sails on, but even though amount A is a dead parrot?
So, Roberto, if you take the first question, and Alison the second, and you can... Sorry, yeah, make it quick.
I have a very quick question. So to Ian, not being in practice, I don't have any sense of this at all. So how common are the problems that you mentioned? Is it an esoteric problem that only a few groups have in very limited cases, or is it more widespread? Is it something? Yeah.
Roberto, can you take Philip's first question?
Yeah. I mean, it's not working. So yeah, Philip, thank you. I think I agree with all the points that you've raised. Very briefly, I wanted to comment on the one in relation to the Fiat case. It's interesting because to an extent, European Commission didn't manage to get through having a sort of EU arm's length principle because of the rejection from the ECJ. So it's like, are they now using the directive to sort of fix the domestic legislation in the member state to have the ALP then within the domestic legislation? But yeah, let's see, it's going to be interesting.
In relation, from a technical perspective, there's absolutely no reason why amount A and amount B have to be connected at all. it's quite possible that you're transfer pricing first of your distribution arrangement. That then gives you a returning country. You then would apply the amount A marketing and distribution safe harbour and work out whether or not you met those thresholds. Fine. That all works with no problem at all. The only reason they are linked is negotiations and politics. And, you know, that's the only reason. Could I see a situation where amount A, with all its problems, doesn't go forward and amount B does? Yes, I could. I absolutely could. I think there are enough countries that want amount B. It is a simplification. You know, it looks pretty good. Why would countries not want to go, hang on, we've got something that works, why don't we take it forward?
Agreed. Do you want to pick the because I agree with that, basically. The answer is it's extremely common. So virtually every HMRC inquiry that we're dealing with, let's say, so I'm one of 16 PwC partners, I must have 7 or 8 inquiries that have all got this as a feature. I'm guessing most of my fellow partners do. I bet it's true for you as well. In Deloitte, it's HMRC see on a regular basis transfer pricing documentation that says this is a limited risk entity, this is a contract R&D provider, this is a cost plus service. Everyone has to make these simplifying assumptions to make their transfer pricing work. All HMRC have to do is now find a few senior people within this so-called simpler tested party to say, we think that the risk control framework might give us some leverage here. Let's have a settlement debate. And so it's absolutely across the board, and it's not just the UK. We see this in Germany, we see in France and other jurisdictions as well. So it's the main issue.
Yeah, and that's true globally. I think we've got
completely. Yeah.
I think we've got time for 2 very final questions, brief questions. Jeff, you get the first, and anybody want the second, you take the second. And we can make brief responses. We can then go and have a cup of tea.
Very briefly, you didn't say anything about PE. So when this senior decision maker moves, there's also a PE issue if there's a treaty there, right?
Yeah. Should I pick that up? Yeah, I mean, yeah, absolutely right. And the way the rules work, and again, I've got to be quick here, which is tricky, but the way the rules work is in a permanent establishment situation, when you've got people moving, you have to delineate your dealing. So in transfer pricing, we're saying we're only going to respect your contract to the extent your decision-making aligns with them. Well, if it doesn't, then you've got this act of redelineation to do. Well, you always have to do that for PEs. And the reality is that that's a part of the, you know, what happens is we've got this, Working Party 1 issues around threshold. They say, well, you've got a PE, and now we're going to pass you over to Working Party 6 to deal with the attribution. But in the middle, you've got this dealing to delineate, and that works in kind of the same way. And it's like, it's not clear who's dealing with that, but that's really exactly the same issue as the one we've been talking about. So yeah, it's a really important point.
And of course, BEPS has reduced the PE threshold test using
Completely.
some very obscure wording playing the principal role. I don't think any of us really understand. Our very final question for the afternoon, please.
Yes, Thomas Renay from Simon Brown in Belgium. My question is one from an EU perspective, EU law perspective, and rather a primary law perspective than a secondary law. If I hear that most important transfer pricing cases are expected to go to the Court of Justice, well, in that case, it becomes very relevant what the court has said, of course. And the court has said in one of the recent cases a couple of years ago that, of course, from an EU law perspective, companies should be able to demonstrate that there is a deviation from the arm's length principle if there are commercial reasons to do so. That's based on all other older case law, but in that recent case of 2018, the court has added that those commercial reasons should result or can include reasons that result from its status as a shareholder of the other company, which basically, if I read this, it basically means the court should be able, a company can deviate from the arm's length principle if it can explain so by the group context, which appears to me like a direct difficulty for the arm's length principle under primary EU law, which then kind of doesn't make much sense to me to see a secondary law directive being proposed. Is that something that you would confirm from a transfer pricing perspective?
Yeah, I mean, it goes back to the fact that, we're still talking about OECD guidelines, and the way they can be interpreted can vary a lot. So even by transposing or bringing them into EU law, I don't think it's going to solve interpretational issues anyway. So you can get many different answers and many right answers, there's an element of subjectivity that makes it really difficult, which is embedded in the application of the arm's length principle. I see that even from a more practical perspective, when you deal with tax authorities, you may be discussing the exact same fact pattern, the exact same functional profile into different jurisdictions with completely different outcomes. So, yeah.
And I don't think that's not isolated to an EU issue. This question of, well, how do you deal with the influence of a shareholder? It's kind of like what I was talking about before, about the fiction we have to kind of come up with. If a court's going to then say, well, no, you need to bring into account the impact of the power of the shareholder, it's like that's when you start going into this conceptual black hole about, well, how is it that we do this exercise if we have to do that? And I think then that goes back to this issue of actually why is the framework creaking? It's because of that issue.
Well, it seems entirely appropriate that we finish this session on a point of intractable difficulty. I would very much like to thank the panel and thank you for paying attention. Thank you.